My name is Nikolai. I'm coming from FinLeap. We are a Berlin-based company builder focusing on Fintech. We were founded last year. We are currently 150 people. We launched 7 companies and are working on 3 more in stealth mode. And today I won't talk that much about FinLeap, about what we do. So I was thinking for myself, what do I want to share with you, which insights that I gained from working in the financial service industry over the last couple of years. And what I want to talk about is the financial service industry, about established players, about startups, and also give you some conclusion of what you should look at when you will consider joining a company, startup, something in the financial service industry, or anything else. So if we talk about digitalization in the financial service industry, what you saw in the last couple of years is that the investors are becoming very interested in investing into fintechs. 2014 alone, there were investments above 12 billion in fintechs. And basically, how we look at digitalization is basically solving old problems in a smarter way. And while we saw some innovations happening in industries like retail, media, travel with companies like Kayak, Amazon, Spotify, you name it, we didn't see that much change happening in the financial service industry. And we think that it's a big opportunity for both sides, for the challengers and for the established players. And if you look at the established players, they have some very strong advantages. So if you look at a company like Deutsche Bank or AXA, they have capital, they have market reach, and they have trust. And these are tremendous assets when it comes to actually selling products or services to customers. But at the same point, they also have some really big disadvantages, which you can basically select into external and internal factors. And if you look at external, especially, for example, market conditions that are changing over the last years, low interest rates, low returns on governmental bonds, increasing complexity in regard to regulatories, and also decreasing trust. Because if you look at our generation, the millennials, what you actually see is many of us don't trust banks anymore. There was actually research made which indicates that 70% from millennials would not recommend their own bank to a friend. Yeah, so you have these kind of challenges. And at the same time, you also see internal challenges when it comes to digitalizing or being innovative, that you could separate into strategic issues, organizational issues, and also the operating model. And if you look at strategy, what I actually mean is that there are some established players that think if you just launch a Facebook campaign or if you create a nice landing page, this is already enough to be a company of the 21st century. And I think this is really a wrong perception of what digital means and what you can achieve if you do it the right way. If you look at the organization itself, you also have to admit that companies with the number of employees, again mentioning, for example, Deutsche Bank, they have way different challenges compared to a small Berlin-based startup with 20 people. Yeah, so you have the complexity of communications, how decisions are made, what is the culture that these kind of companies have. Something like risk aversity, also just not being that execution driven. These are the kinds of challenges that they are facing. And when I talk about operating model, what I mean is that you have to look at the costs that such organizations have. Yeah. If you look at the branches, for example, you maybe just read recently that Deutsche Sparkassen are closing many branches because they realized they cannot afford to run them anymore. And something else which is very, very significant in the financial service industry is IT legacy. What does IT legacy mean? 20, 30 years ago, banks and insurance companies were at the forefront when it came to being digital, being innovative. And some of these companies are lacking behind in terms of actually taking the next step when it comes to their IT systems. And just to give you a good example, the cost per user at Facebook and Google is between $4 to $8. The cost per user of a tier 1 bank in US is around $200. So this is a big difference in terms of how efficient new startups can operate compared to established players. And also there was a research made about financial institutions in Europe, and what they found out is that 70% of the IT budget is actually used to maintain old systems and to be aligned with the regulatory expectations of authorities. Yeah. So this is basically how we look at established players. So there is the perception arises that startups have it easier, they have only the advantages, and if you look at the disadvantages of startups, it's also very obvious that it's not that easy to start something in the financial service industry. Predominantly, many startups fail to have a proper business model. They think just being the next Snapchat or WhatsApp is enough to attract money from investors and becoming a successful company. So this is a clear disadvantage. Another disadvantage of startups is that in many cases they are lacking the managerial experience of running a business, knowing how to grow it from 10 people to 100 to 1,000. And another big disadvantage is capital, because you only have that many months to run before you actually are out of money and you cannot go on. So these are the big disadvantages of fintechs. But at the same time, there are very strong advantages when you look at the organizational structure and the way they can actually empower people. So for example, I think all of you know Number 26. It's a Berlin-based startup. They are at the moment very en vogue with their mobile banking. And the team is about, I would say, 30 to 40 people big. So compared to saving banks or other private banks or insurance companies, very small. But this size makes them also very agile, and they can actually decide very quickly how to move, where to move, and also just be more execution driven. And another big advantage of fintechs or startups in general is basically they have to be very customer centric. Everyone is talking about customer centricity, but if you have only 1 million euros to run before you have to shut down your company, you really have to find out how to solve the problem the way the customer actually is going to buy your service. Because this is basically it. You find your product market fit, otherwise you are not there anymore. Financial service companies can afford to subsidize unprofitable services or products. They can afford to figure out something that doesn't work out in the first, second or third year, sometimes even 5 or 10 years. Yeah. So talking about startups, talking about the established players, many people believe that innovation is only happening in startups because they actually have to get the thing right. If you look at the last couple of decades, it was very obvious that actually banks and insurance companies were the ones that were driving innovation in the financial service industry. And I just recently read a great book. It's called From Good to Great, how some companies take the leap and others don't. And what the author of this book basically investigated is he looked at 1,300 companies in US and figured out which of them outperformed the market and their peers. And eventually, this whole research came down to 11 companies, which they identified that were great. And what they did afterwards, they went to these 11 companies and were talking to them, understanding what it took them to become great. And they identified a couple of criteria that I just briefly want to mention to you. And the first criteria was the CEO. So basically, the leader of the company that was selected to come when the company was not doing well was the one that actually identified what the direction of the business is going to be and how to basically steer the whole organization towards that. The second step of the CEO was to find the right people to bring on board, the leadership team. And what they mentioned in this book is the analogy of a bus. Because the CEO, he's sitting in the bus and he's finding the right people that want to come with him on this journey. At this point in time, the CEOs didn't yet know what the direction of the company is going to be. They just figured out that something has to change, we have to find the right people, and then we are going to look at what the future of our company is going to be. And once they understood that they found the right team, they were brutally honest with themselves, trying to understand what are the business units or things that we have to shut down? Where do we have to cut costs? Where do we have maybe also to fire people? Some very unpleasant decisions that have to be made in order to become a successful company again. And once they went through these criteria, what they did afterwards is basically they identified their own hedgehog concept. And this hedgehog concept is a very, very strong concept or idea. And what it basically means is understanding what this company can become best at. Yeah. Instead of being mediocre, being good, they were trying to understand what can I be great at. And once they understood which direction this company is going to go, they had to be very disciplined because it took them 3 to 5 years before they actually understood that they are doing well, that they are on the right track. And this, as the sixth point, the author is mentioning technology as an accelerator. So instead of what we believe, that technology, APIs, machine learning, and all these kind of things that you are hearing on TechCrunch, on Gründerszene, and anywhere that are driving innovation, it were actually the people the leadership team that was steering the company towards this goal. And if you just have in mind what I just mentioned to you, you can think of investors and how they look at startups. Because as a VC, you want to invest into a company which is not only fancy technology, but which has a very strong core, and the core is the team. And the interesting about these 11 companies that were also evaluated by the author is that 2 out of these 11 companies came from the financial service industry, Wells Fargo and Fannie Mae. So basically what they saw is from 11 companies, 2 were from the financial service industry that had this innovative, outperforming nature embedded into their DNA. And so to conclude, what I wanted to show you is that it's not technology or tech or these things that are driving innovation or digitalization, it's the people. And no matter whether you choose to join a financial service company, you want to work in a fintech startup, or you go to healthcare, education, or anything else, always bear in mind who are the people that you are going to join, because they are the ones that are going to define whether you are going to be part of something good or even great, or something mediocre. Thanks.